friends, I hope you are enjoying this Type 1 to Salary series. Today, what we are going to cover first is your cost questions and where it is used basically for the pricing domain interviews. And second, we will cover are law related questions. So these questions will be used in your industry interviews. Like many FMCG companies ask these questions in the interviews in the past. So please prepare these questions also. People ignore these questions because they think that what will happen. They will not ask from these like costing and from law, but they do ask. So please prepare. So starting with the costing questions, it is like first question, what how the cost sheet looks like. Firstly, direct material in which we add direct labor plus direct expenses, then comes to total prime cost in which we add total factory overheads, which comes to total factory cost plus opening WIP minus closing WIP equals to total cost of production. In total cost of production plus opening finished goods minus closing finished goods equals to total cost of goods sold, and plus administration overheads equals to total cost, and plus selling overheads equals to total cost of sales, right? So this is a very simple cost sheet. And second is what is the target costing? Target costing is pricing strategy in which company sets a target cost of a product. Suppose selling price is 50,000, in which your target profit is 20%. So the target cost is 40,000, right? So the objective of this is to ensure that the product can be produced at a cost that allows the company to achieve its desired profit of 20% in our case, right? That is rupees 10,000. And third question, that what factors we need to consider from the cost element point of view before we price a new product. So these are from the cost sheet itself, like direct material cost, direct labor cost, direct expenses, your factory overheads, your R&D cost, your selling cost, your administration cost. So all these cost elements we need to consider before we price a new product, right? Because pricing involves two things. First, it's your cost. Second is your desired profit, right? And next question, that how we price an existing product in the market. So for pricing an existing product, you need to look into four things. First, your competitive landscape, that how the competitor's product is valued, and second, what is the perceived value of your product in the customer eyes, and third is your cost structure, and fourth is market conditions, right? Next is what is activity based costing and how can it be applied to organization like FMCGs. So activity based costing is a method in which we assign the overhead cost based on activities, and based on activities means we first find out the cost drivers and then we assign these cost drivers to the activities, and finally we allocate the cost which is there, right? And for the FMCG companies, how it is useful, first we need to identify the cost driver, and then we can improve the cost by identify that which cost driver is consuming more cost and which is less. So that's how it is useful for FMCG companies. Next question, what is economic value? Economic value is the perceived value of a product in the consumer's eyes. Like at the time we are hungry, we pay 10 rupees for a particular PTs. And what is the perceived value at the time? It's more than 10 rupees because at the time we are hungry. So perceived value is more than 10 rupees. So this is called perceived value or economic value, right? And next question, that calculation of variances. So companies are there which ask these questions and formulas for the variances, and in some way or the other they focus on the variances, right? So learn these formulas also. First is your material cost variance. It is AQ multiplied by AP minus SQ multiplied by SP. Its reason is that what's your excess actual cost as compared to the standard cost, right? Second is material price variance, that increase in price, that increase in cost allocated to the change in price, right? Allocated to the change in price. So who is responsible for this? Basically the commercial department or the purchase department which sets the price responsible for it, because they promise to purchase at SP but they have purchased at actual price. So price deviation is there and we multiply it by actual quantity, right? Now material usage variance, production department is responsible for it, because they have used less or more of the standard quantity, right? That's why we do actual quantity minus standard quantity multiplied by your standard price. Sales volume variance. In this, the sales department is responsible for increased or decreased sales volume at the standard profit per unit, right? So we do actual sales volume minus budgeted sales volume multiplied by the standard profit per unit. Now sales price variance. In this, basically that department which is responsible for setting the price of the product, right? That is responsible like they promise to sell at budgeted selling price, but their actual sale price is something else. So they are responsible for actual selling price minus budgeted selling price multiplied by actual sales volume, right? Next is your profit variance. Profit variance measures the difference between actual profit and budgeted profit, right? So where is the formula? Profit variance equals to actual profit minus budgeted profit, right? So moving to law related questions which are asked in various industry interviews, right? These questions are like, first question, that in how many days at the end of financial year we need to submit the financials to SEBI? So it is 60 days from the end of financial year. Next is, and if we took a lease from related party and want to classify it as operating lease, so what is the legal requirement and can we do it? So first is, we can do it as per Ind AS 116 if that lease follows the two criterias which is there in exceptions, right? First is your short-term lease and second is low value assets. And what is the legal requirement? That for obtaining such transactions with related party, we have to obtain approvals, and if audit committee is there, then that's approval, right? Now next question, then what is the doctrine of indoor management, constructive notice and lifting of corporate will? These questions we read during our childhood, 11th, 12th, but do revise this also. First is doctrine of indoor management, which says that it protects the third parties by allowing them to assume that the internal procedures are followed, right? Companies running as per laws and regulations, they have to assume that, so they protect the third parties. They do not have to interfere in day-to-day affairs. Second is doctrine of constructive notice. This protects the management and which assumes that the third parties are aware of the public documents and they cannot plead ignorance based on that we are not aware of that, right? And third is your lifting of corporate will, which means that the individuals who are running the company, they can be held liable, they can be held personally liable in case of fraud and evasions of obligations and statutory violations, right? Now next question, that we have to explain the provisions under section 134, 177, 144 and 188 of Companies Act. So let's see. First is section 134. It ensures that the board report includes detailed disclosures of related party transactions, right? 177 is audit committee approval for related party transactions and responsibility of audit committee to oversee such transactions. 144, it maintains the auditor's independence, prohibits the auditor from providing certain non-audit services, right? And section 188 is, it specifies the nature of related party transactions which require board or shareholder approval, right? And mandates the disclosure and justification in the board report. And last question, that what is the procedure of filing application under IBC and circumstances under which it can be filed? So this application can be filed by financial creditor under section 7 when there is default in financial debt, and can be filed under section 9 by the operating creditors after serving notice, demand notice, and when they have not received any payment and they have created a valid legal dispute, right? And next is it can be filed under section 10 by corporate debtor himself and to seek resolution for their own defaults, right? So that's how it works. So that's the basic law and costing questions. That's all from my side. Thank you so much. In next video, I will cover direct tax and then indirect tax questions. So please be with me and subscribe to my channel. Thank you so much.